It's gone 2 o'clock, and I'd like us to get started on time. As we get started, we're going to wait a few minutes for people to join us. I would invite you all, wherever you are in the world right now, to join us with camera on. This is not a podcast. This is a live interaction with real people speaking to real people. So if you would turn on your camera, that would make it so much more personable. If we're simply talking to blank screens, it's hard to get any feedback. I know that our speakers will appreciate it very, very much if you would do that, so that they can read your facial expressions and all of those wonderful things. So, as I said, we will wait a few moments for people to join us, because people are joining us from Asia, from all over Latin America, where time differences are quite extreme. Anyway, so as I warm into this, we want to devote most of the time that we can to our two key speakers. But let me introduce myself. My name is Carl Voigt. I'm the academic director of our Ibear MBA program here at the University of Southern California. And I want to formally welcome you to our masterclass hosted and sponsored by the USC Marshall Ibear MBA program. We're certainly excited that you've joined us today, that you've chosen to take some time out. Today's topic, I think, is worth giving some serious thought to. And I could talk for way too long on that in terms of the importance of it. Let me just talk a little bit about the format of the time that we're going to spend together. We'll start with a masterclass, which will be a short, stimulating talk by Professor Adlai Wertman, and then an exchange between Adlai and Jared Metzger. Apologies, Jared, for choking on that. It's not that I don't know you, all right? We will then do a Q&A session. And as we prepare, as you come up with questions, the way we're going to process the Q&A is to ask you to put your questions into the chat as you get them. And Jared and Adlai will peruse the questions. What we don't want is all the questions to come in at the end, and then it'll be difficult to sort them out. So please go ahead, and as you come up with a question, write it in the chat right away. So, and then not the most important, following our master class with Adlai and Jared, we will have an information session for those interested.
Hola, César, perdón, el retraso.
We'll have an information session on the Ibear MBA program specifically, but for those of you who might be interested in other programs at USC in particular, Adlai is the director of our social enterprise program. I'm sure he would love to take questions on that as well for people that would be interested. Our Ibear MBA program is a one-year intensive full-time MBA program for experienced professionals. For those of you who are interested in learning about an MBA degree in the US, we invite you to stay on, and Pankaj Gemawat will lead out that session with us. Since this is a master class and an exchange, as I said before, please turn on your cameras, right? It's not a podcast. If you'd like to listen to the recording, you could do that afterwards. But again, I would invite every one of you to turn on your podcast so you can give our speakers, turn on your cameras so you can give our speakers, visual feedback as they talk to you. By way of introducing Adlai and Jared and their topic, it would be easy to say that they're bankers. They're investment bankers, just to classify them and say they're going to talk about finance topics. Yes, they both have extensive experience in banking, and they've earned their chops to speak authoritatively about financial issues and financial topics. They don't need to qualify anything that they say, but they are much, much more. They're two leaders who not only think differently about these topics, but they live their perspectives. Both believe that business is important. but they both believe that business and investors can and should do much more, much more. Adlai transitioned from an investment banking career to leading Chrysalis, a program in Los Angeles for rehabilitating homeless people. Talk about a switch of careers. And it was successful in both. We were lucky to seduce him to come to USC Marshall to be the founder and to direct our Brittingham Social Enterprise Center. Adlai cares about the big issues. He and I have had conversations. He's spoken to my classes that, he believes that business must address these big issues if it is to stay relevant in a world that is increasingly distrustful of business elites. I mean, there are people who are willing to burn it down because of the way that business has been done. Jared brings to our discussion today a wealth of practical experience. Part of it's taken him to, other parts of the world as well. And I'm sure he'll talk about that. To use a tired analogy, but one that's really relevant, he walks the talk about what he'll talk about today. Jared has also had the misfortune of being a student of mine. And so I'm so pleased to welcome him back to talk. And Adlai, thank you, gentlemen. I'm not going to go into the details of your resume with LinkedIn and social media. You are both well and truly documented. So we will, we'll leave it to you to do that. Thank you for joining us today. One more appeal to everybody. Would you please join us by turning on your camera? Thank you. And with that, I'm going to turn it over to my colleague, Adlai. It's over to you, sir.
Thank you so much, Professor Voigt. I would say that hearing Professor Voigt talk about business's responsibility in the world and all of this is a phenomenal thing to hear. I'm not sure we would have that same discussion when I came to USC 14 years ago. And I think we've all evolved since then. My background, as Professor Voigt mentioned, is 18 years as an investment banker, 8 years running a homeless agency on Skid Row, where we ran a large business helping homeless people get to work and giving them their first job. That business is now a $50 million business, but I take no credit since I left 14 years ago. And seeing the power of running businesses and the power that business education and models have in influencing and solving and addressing social, environmental, and health access problems is why I came to USC Marshall it's just about 14 years ago to the day, to start a center, the Brittingham Social Enterprise Lab, focusing on exactly that, how we can use a business education, business experience, and business models to approach social, environmental, and health challenges throughout the world. One of the things that's come up in this world is this notion of impact investing. And I'd like to say that we invented that. I'd like to say it was new, but actually it was created in 1976. And it was started, believe it or not, by the church. So churches religions had a problem. Their problem was that they had money that they needed to invest, whether it was the endowment of the churches or just their building money that they had sold, is that they could not invest their money in alignment with the values of the church. That option wasn't really available to them. What they really cared about is what they called at the time sin stocks, S-I-N, sin stocks. And those were companies that were tobacco, alcohol, and gambling. It didn't agree with what the church believed in. So somebody had to figure out how they can invest their money without sort of having to pick individual stocks. So a company was started called Calvert, C-A-L-V-E-R-T, who created mutual funds. And those mutual funds were built to remove those items and those stocks from what they could invest in. So I could invest in the market, but be sure that I wasn't investing in things that my religion told me I shouldn't be supporting. that has grown. So what impact investing has become, and it is now $7 to $9 trillion market, what it has grown to become is a way for all of us to invest in alignment with our values, to invest in a way that says, we don't want to involve ourselves in this, or we do want to have a positive impact in that. So let me walk through that a little bit, and then I'm going to ask Jared to talk a little bit about exactly the model that he uses in impact investing. So the first part of impact investing is exactly what we were talking about, what I was just talking about in Calvert, which is what we call a negative screen. Right. So what we're looking at is there are thousands and thousands of stocks that I could invest in. How do I screen out things that I feel negative about? How do I say, these are the things I don't want to invest in? I don't want to invest in oil. I don't want to invest in things that are hurting the environment. I don't want to invest in, there was a big part, Calvert funds were first ones to say that we don't want to invest in any region that is involved in apartheid. These options became quite big and are probably still the biggest part of the market for impact investing. And there's a reason for that. The reason is because I can put an unlimited amount of money into that, right? So if I think about it, if I want to invest only in companies that are doing good, and we'll talk about that in a minute, it wouldn't be possible for me to put $7 to $9 trillion in that. There's not the capacity in the market. So what I can do is I can invest in the stock market in general and just say, leave out these stocks, right? So that negative screen is the largest part of the market. The second part of the market becomes this area of me actually starting companies who are built to solve these problems, right? So I think the easiest, we call them social enterprises, we call them social entrepreneurs, but they're very traditional entrepreneurs. So think about it as if a traditional entrepreneur says, here's a market gap, and I see that market gap as a way to start a company. Social entrepreneurs say, here's a social, environmental, or health problem that I want to address. And I'm going to create a product or a service to address that problem. And I think the one that we probably all around the world have heard about at this point is Elon Musk and Tesla, right? So Elon Musk was an environmentalist who said, okay, look, I believe in global climate change. I believe that combustion engines contribute to global climate change. So what am I going to do to address that? I'm going to invent and sell an electric car. And he creates an electric car company that is built to solve an environmental problem, right? That obviously scaled enormously. I understand he's now the richest person in the world. But I want him to be the richest person in the world. I want it because every time he sells another car, it's solving a problem. It's better for the environment. So therefore, I have now the opportunity to invest at scale, a lot of money, into a company that was built to solve a social, environmental, or health problem. So now I can be positive. I can say, not only am I not investing in this, but I want to invest in positive companies that are making change. Bless you, whoever that was. So I have that opportunity, and now we're seeing a lot of investors, venture capitalists especially, create special funds just for companies that are doing this. I've been working with a venture capital fund that just started recently that is doing nothing but investing in construction technology that will lower the price of building affordable housing around the world, right? People are getting very creative about how to put their money to work. Two other things happened during this period of time that really have changed things. One, a big effort towards diversity, equity, and inclusion among companies around the world. and who they hire. And the second is an understanding by investors, and this will lead to Jared, an understanding by investors and by companies that the model of building and running your company solely to provide the highest return for shareholders. I'm saying solely. So we have a name for this. This was started in 1972 by Nobel Prize winning economist Milton Friedman, who in 1972 wrote an article in the New York Times that said that the sole responsibility of business is to maximize shareholder value, is to make as much money as possible for shareholders, that anything other that they pay attention to, any other issue about the environment, the world, is socialist. And that model stuck for 50 years. That model, or almost 50 years, that model stuck, and we have a name for it. We call it shareholder supremacy. Shareholders over everything else, right? Several things changed in the last few years. So what's changed is this. One, as the environment has gotten tougher and more obvious problem, companies started realizing, or actually auditors, accountants started realizing that that having hurting the environment can actually present a risk to your company. And as diversity, equity, inclusion happened, they started to realize that if you don't have a diverse group of people, right, then you're also creating a risk to the company that they are then going to disclose to people. So the biggest one was when the auditors for Pepsi said years ago that access to clean water is a long-term risk for Pepsi that they needed to disclose in their audits. I mean, that's a giant deal. And once we came to that conclusion, we started looking at what else creates that. And we came up with a model called, and Jared, we'll talk about this, called ESG. Right? ESG is environmental, social, and governance. So environmental, obviously, how are we mapping the environment? Social, meaning what are our products, employees, what are we doing in the world that we're living in? The communities we work in, the communities we sell things to. And governance being, is my company being led from both a senior administrative as well as a board level, a board of directors level, by a diverse group of people? Are there women on your board? Are there people of color on your board? Which, you know, as we all know, traditionally is not the way large businesses worked in America. Once we started to realize that this was a real risk to the company, about 2.5 years ago, BlackRock is a asset manager. It's the world's largest asset manager and manages about, I think they're up to $9 trillion of investor money. So the CEO of BlackRock wrote a letter that was published in the Wall Street Journal and the New York Times. And what the letter said is that we now realize that ESG, that the stakeholders beyond just shareholders, which they are the biggest shareholder in the world, right? That the stakeholders out there should have need to be widened. It can't be just us, because you're creating risk for us if you're ignoring all of these other stakeholders. So they demanded that every single company that they invest in produce a report that says what they are doing and how they are doing in ESG, environmental, social, and governance. That there is now, auditing firms are making a big living producing these reports. And we have companies out there who have created ways of scoring companies on ESG. And what they said is, if you don't at least disclose to us what you're doing in ESG, this is what BlackRock said, or even better, mitigate those things, then we will not invest in your company. Goldman Sachs said that if you do not have a strong governance, a diverse governance, we will not bring your company public. We now start to see these major players engaging at a level that we never would have expected. And suddenly, sort of not surprisingly, but almost surprisingly, about a 6 months or to a year after the BlackRock comment came out, the Business Roundtable, the 100 largest businesses in America, CEOs wrote a letter and said, hey, we just woke up yesterday and realized that shareholders aren't our only stakeholder. Like, duh. That our stakeholders are also our own employees, our own customers, including in our investors. And as Jared's going to tell you, the investors have a benefit to the fact that companies are saying that. So here you go. We're saying that we're going to pay attention to people other than just shareholders, and shareholders are saying that's great, right? So very interestingly, we now have this wide world of organizations that are investing in companies that have high ESG scores, or not investing in companies that have low ESG scores. And as we do that, as we now have brought in negative screening, the opportunity to proactively look at companies that are doing good, traditional companies that are doing good on ESG scores, and that we are disclosing it, and venture capitalists and angel investors and the rest of us having an opportunity to actually find a company that we think is doing good in the world, that is solving a problem with their product or service, and we get to put our money to work with them. This is a game changer. There's a million models of this out there. There are models of VCs who will only invest in social investments. There are VCs that will only invest in diverse founders of color, women. We are now changing the viewpoint of who you can get money from and how you can invest. Jared, I'm going to ask you to step in here. Jared is a Trojan, a graduate of Marshall. So Jared, if you could just do me a favor and spend a minute telling us about your path or two to get where you are. And then if you could just tell us about the model you're using in your social investment fund.
Yeah, absolutely. Thanks, Hadley. That was a great backdrop for what we're talking about today. Myself, I started my career as an equity generalist in Los Angeles. I then went to Almaty, Kazakhstan, where I did emerging markets, private equity, and helped set up a family office. Repatriated and spent close to 10 years with Bank of America, where I was helping to manage the bank's discretionary portfolio, which is about $600 billion. From there, went on to Switzerland, where I worked for a registered investment advisor. We were managing about $3 billion, primarily for families and individuals. So I've seen a broad spectrum of capital and asset classes. And what I've found was there was this growing need and desire for a more positive form of investing. So you talked about the negative screening initially, but once we started collecting more data on environmental, social, and governance factors, there was an ability to be intentional and deliberate about what you're doing. And so what we really do here at Anuvia, which is my shop, is we do ESG investing, and we're very focused on how these factors tie into our portfolio companies' corporate strategies. And we think about ESG factors as being non-financial risks that are also investment risk.
So how does that play out in actual investing?
So what we're actually doing is we'll go out and we start our investment processes with factor analysis. And that's going to be a combination of financial factors and actual ESG factors. We use the Bloomberg terminal. And to give you an idea of what this looks like, the Bloomberg terminal has over 1,200 data fields that fall under the E, S, or G factors. And what we're doing is we're going out and looking at these factors over time and how they were related to forward stock returns. And so we're trying to identify factors that, as the quality of said factors improved, future returns of stocks outperformed, and we break our universe up into quintiles, different groups, where we can start to see, here was the value of a factor at time zero, and this was what the forward return looked like over 1 year.
Could you give us an example?
So what we do, right, is the actual factors that we use are proprietary because they're part of our investment process. But what I can tell you is that we're very focused on the quality of these factors. An adage you've been hearing in the space is what can be measured can be managed. And what we try to do is we're looking at this and saying, okay, there's all these risks to a business. Primarily people were focused on financial risks, but you can think about, you know, supply chain risks. You touched on clean water with Pepsi, carbon footprint. Beyond just board or management governance, you can think about shareholder classes, you know, A's versus B's and voting control. There's all these factors that play into a business and associated risks with that. And what we want to do by finding businesses that have a higher quality in their ESG disclosures is we want to de-risk our investment. And so the basic premise is that as you have more transparency into a business, you are taking away uncertainty for investors, and we can then go out and put a better level or price target on a particular investment. So you're de-risking the whole investment process by increasing your corporate transparency. And I think the other thing that ends up doing is it creates enhanced business quality. So the quality of the business overall that you're buying is better. And to your point earlier that you talked about, you end up creating a more inclusive form of capitalism, and that you challenge management teams and boards to think beyond the shareholder and to consider stakeholders, right? Their employees, their customers. And so you have a collective benefit to a wide array of people versus that traditional Chicago, you know, shareholder model.
So Jared, I don't want you to give up a name. So two things. One is you also use the opportunity as sort of a shareholder advocate, right? Meaning I am a potential shareholder or a current shareholder. I'd like, you know, as an owner of your company, I'd like you to sort of think about certain things. How have you approached, or if you want to give an example without giving a name of a company, how might you have used your shareholder advocacy to push a company to do even better, which allows you to perform even better?
Yeah, absolutely. So in our case, what we do is the vast majority of our portfolio is invested into what we call our ESG leaders. But beyond that, we have our emerging companies, and these are companies that we think are doing the right thing, but they haven't put together the full story yet. And typically what we'll do is we'll go out and engage with those management teams and show them the research we've done around ESG disclosure quality and outsized future returns on a forward basis. Most recently, we had a company that we went out and engaged with them, talked about ways that they could align ESG factors with their corporate strategy. And what we saw over the course of a year was they ended up increasing their female representation on the board to 40%. They increased their ESG data disclosures by 79%. And actually, most recently, they went out and republished their strategic initiatives, and they made the alignment of ESG factors to their business their number one strategic priority going forward, right? And one thing that we like to think about here is what really is the best investment, and we like to say it's a sustainable investment. And so we saw that particular management team of this small cap company that we were invested in really buy into it and start to employ it and live it and tell the story to the market, which ultimately can lead to a re-rating of the company and a higher multiple that you can put on that particular investment. Because again, you've increased corporate transparency, people are understanding what they're getting better, and they can put a better value on a business.
Have you gotten pushback from people who sort of didn't want to talk to you about this or thought this was nonsense, or were you or were you drawn towards companies that were already thinking about this?
So when we're talking about our emerging companies, we have a proprietary way that we're going out and analyzing them. So I would say more often than not, we found these companies willing to embrace what we were telling them, and they needed kind of help moving up that spectrum. But absolutely, in conversations with people, you do run across individuals who just don't believe it. They think of it as, well, if I'm going to do good, I have to give up return in some way. It's difficult for people to understand that the two can go hand in hand, that doing the right thing can also lead to outsized returns.
So I just want to jump in and answer Rico's comment. Yes, there absolutely is a list of best practices, and also a list of what factors people follow, right? So I think PwC, Price Waterhouse Consulting, also just produced a paper recently on all of those factors and sort of tracking them. And as I mentioned, we're actually scoring companies now. So a friend of mine created a database working with BCG, a big consulting firm, that actually scores it and can go to those companies and say to them, if you make these changes in the way you work, in parts of what you do, I can predict how that will impact your ESG score. So there's lots of ways that people are getting on top of this. Parry, I just want to get your question. The current approach from asset management companies focus on score and encourage static approach. However, what do you mean by static approach as opposed to dynamic? I want to make sure I'm answering the right question.
Hello, and thank you for taking my question. Yeah, by static, what I mean is they focus on scoring companies and ignoring some and selecting some. Environmental management system, when the standards, when they started in the 90s, they focused on the changes, positive changes a company made. So they didn't care about where they started. As long as the change was positive and impressive, that was the criteria for selection or scoring. So that's a dynamic and impactful. Currently, by selecting just based on a score that we're giving at a point in time, we are kind of more static.
There's no doubt about it. I thank you for that. That's a brilliant comment and observation. I agree that anytime we start scoring something, we are taking a snapshot. Nonetheless, I think, Jared, and you can answer this. How much time do you pay attention, Jared, to a trend in ESG scores as opposed to how they're doing on a specific 1 year?
Yeah, so we have a framework that we've developed, and you can think of it as 4 quadrants, right? And we'll have, kind of our leaders are out here in the upper right quadrant, and you have your emerging down here in the lower left. Then you would have a quantity focus and a quality focus. And so your y-axis is quality and your x-axis is quantity of overall disclosures. And so what we're trying to do is then track how they're changing in addition to where the actual score is. So obviously when companies are moving up their disclosures, that growth rate of change is larger than once they get out here. But once they're here, we don't want to see them reverting back to a different part of the quadrant. So, right, there's quantity disclosure focus, there's quality disclosure focus, there's the leaders, which do both well, and I would like to say emerging, trying to keep things positive for those who are at the beginning of their ESG journey.
Thank you. Jagriti, CVC, right? So CVC is a large investor. I think that they are bringing. My understanding of them is they're already bringing ESG in, as they're not just looking at strategic, but they're also looking at impact. That within and of itself is sort of this broadening of terminology is extraordinarily helpful. I used to be in a field where we helped homeless people get jobs, right? There were lots of organizations around the world helping homeless folks get jobs, or extremely low income people get jobs. Except that when we all reported something different, right? Meaning we spent a lot of time talking about in the industry, what's a job, right? Just what do we mean when we say someone got a job? Is driving an Uber, is a gig job a job? Is working 20 hours a week as a temp a job? Does it have to be a full-time job? All of these questions come up. This is the same thing here. So in the world of what we've had before the auditing firms got involved, is that we didn't know what ESG meant. We had no way to we had no common language. We had no way to say, the industry had to come together and decide that greenhouse gases were something that needed to be measured at a way of scoring ESG, right? That we're going to say, okay, how do we know the environmental piece? One of the main pieces we're going to look at is how are you doing on a trend of how much greenhouse gases you're putting out, right? That in and of itself became harder and harder for what we continue to see. And I think this is, the continuing challenge of, or many challenges I'll talk about, but one is what we call greenwashing, meaning a company saying that they're doing things that really aren't a thing, right? That are trying to make them look better, but they aren't actually implementing it. The one I'm always amazed at, for example, is I keep hearing TV commercials or seeing TV commercials. I watch sports, so I still see commercials that say that Exxon is the biggest investor in alternative energy because of all the money that they've been putting into algae as an alternative fuel. I just want to ask those people whose cameras are on, raise your hand if you've ever heard about people talking about algae as an alternative investment. No, this is, Dick, of course you have, because you've been watching sports with me, Dick, so that's why you've been doing, you've heard it. It is not the thing that people in the industry are talking about as the way for alternative energy, but it is a way for Exxon to claim that they're doing something. And because Exxon's so big, whatever amount of money they threw into something would make them the biggest, and certainly the biggest in terms of algae. So we are seeing a ton of greenwashing still, which is companies, whether it's just environmental or social and others, and governance, we see a lot of people making themselves look better than they are, or trying to make themselves look better than they are. And those are most of the TV commercials that we read in the magazines now. You might notice how many of them have stopped talking at all about their product and just talking about all the good they do for the world. So if you haven't noticed it, start watching. Start taking a look at companies that all you see on their side is don't buy my car, right? And there's I've noticed that General Motors has had a phenomenal push on advertising lately on their next generation electric, which is their number one focus is they're electric. But they won't have that electric in place for probably 2 to 3 years. Yet you would think that they're the biggest electric car manufacturer in the world based upon their advertising. That's sort of the greenwashing that's a risk. The other challenge I'm going to say is convincing traditional investors that they won't lose money if they take their eye off the ball of paying attention to nothing but financial factors. So a big challenge is going to be, I run a social entrepreneurship program, which is students who want to build companies to solve these problems. Their biggest problem traditionally has been getting anybody to invest, because the minute we walk in front of an investor and say, there's a social benefit to this, the investors would traditionally used to throw you out of the office and saying, how dare you talk about anything that might not be about making us a ton of money. I tell my students that if they're pitching a company, they should have 15 slides, right? And if they're pitching a social investor, they should have slides 1 to 11 say, I'm going to make us all so much money. Slides 12 and 13 say, here's what good we're doing for the world. And slide 14 and 15 say, and oh, by the way, did I mention how much friggin' money we are going to make? And that if they're pitching to non-social investors, leave slide 12 and 13 out of your proposal totally. Right? That model's changing. That model's changing, one, because of the Jareds of the world who are saying, actually, you're wrong. We de-risk your investment, and we actually play to your customers, to your employees, as well as to your shareholders to do this. So that is something. And by the way, there's money to be made solving social problems. This is a viable market, this is no longer about solving social problems through charity. This is about, and Jared uses the word, can we create sustainable change? And if we're going to create sustainable change, financially and otherwise, it can't rely on charity. We're going to have to keep pushing the idea of traditional corporations taking more responsibility. And we're going to do that by investors, as employees, as consumers, starting to have our voices heard in this picture. The other challenge is going to be, is that we have found as we go out there that there are many, many investors who are also greenwashing. They are investment managers saying, give me your money and we'll do good in the world. And they're not. They are taking an investment thesis that is minimal, impactful, definitely not positively impactful, and saying, sure, we'll do that. Because they don't want to turn the money away, but they also don't know how to do this investing. They're not putting the work that Jared is putting into his company, into his investment thesis. They just know that, God, we have these investors that want this stuff and I'm not going to send them away. So yeah, we are going to do that too, right? But to get behind their investment thesis, to see what they're really investing in and how, you sort of see much more greenwashing. Erica, tell us about your company. I would love to hear it.
Good evening for everybody. At least here in Brazil is evening, but I work at Eletrobras. It's a state-owned company, and this company is working with generation and transmission of energy. And we have now a big program in sustainability. And I have worked in this program as well. One thing that we are doing now is trading IREX, but the program have 18 initiatives for sustainability. We have some problems because we have, in spite of we have a clean energy in our matrix, because we have 92% of hydroelectric power energy in our matrix. We have some kind of energy that is not clean as well, 8%. But we are worried about this kind of questions, and I think that is very, very important to discuss and to give some answer to society about sustainability.
Beautiful. So, I mean, there's a great example. By the way, in my social entrepreneurship program, we attract a lot of students from Brazil, because Brazil is sort of very advanced on the concept of using business and using your money to actually make the world a better place and to solve big problems. So it's great to have you on the call. Thank you for sharing that. But look, we're looking at traditional electric companies, traditional utilities, now thinking about alternative energy. This is not just because they're good people. It's also because they know that that using carbon emission fuel is not possible anymore. It's not a long-term solution for any of us. It's not a long-term solution to the earth. And what we need to do is, as one of those stakeholders, as investors, we now have the opportunity, this is sort of my pitch, we now have the opportunity to engage with our money and to say to companies, we are going to reward you for behavior that aligns with my family, with my kids, with my grandchildren, right? We want you to take responsibility for more than just making XYZ people money. I want to make my money, but I also want to reward you by helping you make more money and your stock go up because you're taking bigger responsibilities, because you're stepping up on these issues that are important to me, important to my family. And this is why there's $9 trillion at this point being invested in social impact. And this is why, Jared, you're seeing, how long do we have until Pankaj, sorry.
You have another 14 minutes.
14 minutes. Wow, I can talk for another 2 days. But I can always hand it over to Professor Voigt, who can talk for 3. So, Jared, Jared, give us an example of what a typical investor into your fund might look like.
Yeah, sure. I think before we transition to that, there's just one thing I wanted to bring up, and that I think it's important for everyone to remember that we're still relatively early in this journey, and things are increasingly being better defined, but we're still building consensus, right? And you see that most recently coming out of COP26 in the last week or so, and the things that need to happen. And I was talking to someone from a large foundation this morning, and this foundation has traditional investments, and they also have sustainable investments, namely in ESG. And the gentleman was even asking me about, questions that he had about some of the ESG investments that they have. And he was looking at some of the companies, and even in his own mind, he was like, they're in our ESG strategy, but I even wonder if they're really, sustainable. Do they really meet the criteria? So I think we have to understand the intention of where we're going in the context of where we are. And it's important for us to drive this change, but also have some patience as we try and get to where we want to go. And it's going to get better with time. And when people like myself come into this and bring a different level of rigor around the investments and what's required, and we're having dialogue with people like Adlai or Professor Voigt, you're seeing the sort of collective intelligence that's being dumped into this dramatically increase. And I think that's going to result in a much better outcome. And so for us, really, ultimately with investors, it's, individuals, families, foundations, endowments, and family offices right now.
I think so. I think this is really important. I mean, first of all, Jared, your first question was brilliant. So let me get Pari to answer this question before I jump in with more. So her question is, how do you engage shareholders in ESG efforts through your portfolio? So the actual shareholders.
So we are shareholders ourselves. So what we're doing is we go out and invest in these companies, and we hold the shares, and then we'll vote proxies, and we represent our shareholders in front of management teams where we need to. And so how we do that, right, is we'll go out and reach out to the head of IR and start to strike up a dialogue with our emerging companies, and with our leaders. We tend to manage that more through just traditional proxy voting, unless there's something that we really feel like we need to take a stance on.
Thank you. And I just want to add for 10 seconds. this is not just, as Jared said, individual investors. This is institutional investors. And the biggest of the institutional investors are foundations, pension funds, organizations where they have a lot of money to invest, and also high stated social causes and values. So want to make sure that for foundations, for nonprofit foundations who have billions, enormous amount of money to invest, that they're investing in alignment with their, so if they're an environmental positive, trying to give donations and grants to pro-environment, they shouldn't be an investor in an oil company, and they should invest in companies that are aligned with them. Dick, I believe somebody from an Ibear alum has done some ESG work.
Yeah, thank you, Adley. An Ibear 5 alum, 1983 graduate, ran Glencore for the last 20 years. And Glencore is a gigantic trading firm and resource mining firm. And I had the chance to interview him on July 23rd for an Ibear executive program, hybrid from Zurich. And Ivan Glasenberg said that his replacement, who was a person who came up through the company, will now be spending probably 40% of his time, the new CEO of Glencore, on ESG issues. And that's how important it is to them. And this is a company that makes huge profits all the time.
Yeah, it's unignorable. And it's unignorable for, especially in the environmental side, for those of us who are parents, those of us who are grandparents, those of us who understand that we need to push companies to make this change. We need to push companies to pay attention to these issues. And we can do it, as Jared brilliantly points out, we can do it while still making money. And we can do it by participating in the field. So we're seeing more and more jobs available because there are more and more institutions and individuals that are demanding that this be part of their investment portfolio. So the opportunities for jobs in this world are the same, are the traditional finance jobs, but with a bent. So this is not, the companies that are doing this impact investing, right, are not hiring social workers, right? They're not hiring people necessarily, the investors are not hiring people who need to know how to solve these problems. What they're doing is they're hiring, just like any other investment, as Jared said, first thing, we need to make sure that this company financially is a good investment, right? That we understand ROI, we understand risk-adjusted ROI as a basis upon which to build these companies or to invest in these companies. On the other side, you have, as Dick pointed out, people running large companies, right? Very large companies. These people who come in don't have to be experts in the field of social impact or on DEI. They just have to be an expert at running a big company, at being a great investor, and they have to add to that expertise a desire to learn and work on these second set of issues. But if the deal doesn't work from a money side, nobody's investing. The question is, for deals that do work monetarily, how do we also push them to outperform by doing this more extra work that will make them sustainable long-term investor? Marina, how do I perceive transition from clean energy from the investment? I think that, I would love to throw that back to the group if we had more time. I don't think there's a option but clean energy. I think the option, the question is, how late is everybody going to get before we realize that that isn't an option? How long are we going to let this go before that doesn't happen? So the answer is, we're not going to unplug from the wall, right? That's not going to happen. But nonetheless, to the extent available, we have to start making sure that we take advantage of what's out there. And we, just like that Professor Drobnik said, we running companies have the ability to say to our suppliers, to Erica's company in Brazil, that's an electricity company, we want to buy more sustainable electric from you. So the more you do it, the better a customer we're going to be. If not, we're going to take our business elsewhere to where they do care about alternative energy. So you're right, at this very specific moment in time, there's a risk there, but we have to keep pushing companies as investors, as employees, and as consumers. And remember, the companies you work for as investors, consumers, and employers, right? We have to look at them as, how are they spending their money? Who are they doing business with? Who are they hiring? Do I want to work for a company that isn't doing impact-related work? Right? That's, you know, I'm running late, but I'm going to give you one last thing, and then I'll hand it back to, I know Professor Drobnik has something to say.
Adley, just on that point,
please.
you know, last week, our dean, Jeff Garrett, interviewed Mark Benioff at Salesforce. And Mark, the CEO of Salesforce and the founder, just explained to all of us that all of their suppliers have to be hitting ESG activities, or they're going to cut them off. And, you know, Salesforce is a force in the marketplace, as you're saying.
Right. So, I mean, this, thank you. And by the way, Mark Benioff gave me the first $1 million to start my center 14 years ago. So he and I agree on this very much. If I can send you off with a request, take from this and from other things you're learning and create a new synapse in your brain. And that synapse says, when I'm involved in investing, when I'm involved in product development, when I'm involved in marketing, when I'm involved in procurement for my company, when I'm involved in supply chain, when I'm buying something at a store, create this tiny synapse that also runs it through this ESG filter. That also says, is this a company I want to work for? What are they doing for the world? Is this a company that I want to buy from? Is this a company that I want to invest in? That is a power that we all have. And it doesn't need to be front of mind like it is for Jared and for me. It needs to just be a little synapse, a filter that you run things through. I'm going to run over if I go any further. So thank you for giving me this opportunity. I will just tell you that Marshall cares about this. Ibear cares about this. Our professors care about this. And these things are and will continue to be built in to all of the experiences you have if you join us at Marshall. And if you do come, please pop by and we can have a cup of coffee. So thanks again. And I'm gonna jump off in a minute because I have another presentation to make. But thanks again, everybody, and stay well and invest well.
Adlai, thank you. Jared, have you got any final comments that you'd like to share before we transition the session?
No, I mean, I guess I would close with thank you for the opportunity to speak to the group today. And I really loved the insightful discussion and the great questions and commentary from the group at large. It was a great dialogue and I appreciated being part of it. So thank you.
Thank you, Jared, personally, for coming back and sharing your heartbeats with us. For those of you who are interested, we are going to now transition to